Welcome, everyone. We are so glad you can join us today. We know you have a lot of choices, and our whole mission here is to, cut through all the noise of these huge corporate events and really pull out the insights you need.
Yeah, to get you the actual knowledge without you having to spend hours reading through transcripts and dense filings.
Exactly. And today we are focusing on an absolute titan of the financial world, Bank of America Corporation, or BAC as it's known on the ticker. We've got the complete transcript from their Q4 fiscal year 2025 earnings call right here.
And we're going to be breaking down every key comment from the CEO, Brian Moynihan, and the CFO, Alistair Borthwick.
We are. But before we jump into what were, frankly, some surprisingly strong numbers and their whole vision for 2026, we have a quick but really important ask.
hmm
If you find what we do valuable, if this saves you time and makes you smarter on the topic, please do us a huge favor. Go ahead and hit that like button, share this with anyone you think would be interested, and of course, subscribe so you don't miss our future content.
And your support it's literally what fuels this channel. So we'd also kindly encourage you to just take a look at the membership options. It's what allows us to keep making these videos.
Absolutely. And if there's one specific insight today that really clicks for you, you can always show your support with a super thanks. We really appreciate it.
Okay, so our scope today is pretty comprehensive. We're going to start with the prepared remarks from management. That's where they lay out their official story, the results, the guidance.
The curated version.
The curated version, exactly. But then we get to the good stuff, which is always the Q&A session. That's where the real texture comes out.
For sure.
We've picked out 12 really rigorous exchanges between the top Wall Street analysts and the management team. And we're going to break down what those analysts were really digging for.
Things like capital deployment, right. And the big one, their path to efficiency gains through AI.
Oh, yeah. And the whole outlook for net interest income. We're going to look at what they asked and, more importantly, what Bank of America revealed in its answers. Think of this as your shortcut to really understanding where BAC is headed for the next few years.
All right, let's do it. We're diving right into those prepared remarks, starting with the big financial scorecards for the fourth quarter and the full year.
Let's get into it.
Okay, so let's unpack these headline numbers, because they really do signal a lot of momentum. Q4 was a very strong finish to the year for Bank of America. They reported a net income of $7.6 billion.
Right, and for a company of that size, a 12% increase year over year, that's not a small feat. That's real, meaningful growth.
It really is, and that strength, it flows right down to the shareholder level. Their earnings per share, or EPS, hit 98 cents.
And it climbed even faster than the net income. It was up 18% compared to the same quarter last year. And that acceleration, management was very clear on this. It was driven by revenue, not by just cutting costs to the bone.
And that is such a critical distinction, isn't it? Because anyone can cut costs for a quarter. But they delivered 7% year-over-year revenue growth. And the engine behind that, the real powerhouse for a bank, was their margin business.
Net interest income, or NII.
Exactly. NII was up 10% year-over-year, hitting $15.9 billion.
And it's important to point out that that NII number is on what they call an FTE basis,
Right.
which stands for fully taxable equivalent. It's a bit of an accounting adjustment, but it basically gives you a clearer picture of their true earning power by leveling the playing field for tax-exempt income, like from municipal bonds.
And Moynihan said they actually came in a bit stronger than they even forecasted on that number.
He did, which tells you that the underlying interest rate environment and how their balance sheet is positioned really worked in their favor this quarter.
I found the whole discussion around operating leverage to be really compelling. For anyone listening who isn't familiar, that just means your revenue is growing faster than your expenses, you're getting more efficient.
Which is the name of the game.
It's the whole game. And they delivered a massive 330 basis points of operating leverage just in Q4 alone. They said it was all about disciplined expense management.
And when you're talking about an institution with a multi-trillion-dollar balance sheet, that kind of leverage is a huge sign of real structural improvement, not just a one-off good quarter.
It is, and it wasn't just a quarterly thing. When you look at the full year performance, it really shows they're executing. For all of fiscal year 2025, BAC brought in over $113 billion in total revenue.
Which was up 7% year over year. And the full year EPS hit $3.81, a 19% increase.
So it's not just growing the top line, they're making every single dollar of that revenue work harder and more efficiently.
Precisely. They kept that operating leverage discipline all year, generating 250 basis points for the full fiscal year. And that sustained efficiency It leads directly to better returns for shareholders.
Let's talk about those returns. The big one is ROTCE, right?
Right. Return on tangible common equity. It's kind of the banking industry's go-to metric for profitability. It basically measures how well management is using the capital that shareholders have given them.
And that improved to 128 basis points. Their return on assets, or ROA, also climbed to 89 basis points. These are all signs of a fundamentally healthier business than a few years ago.
For sure. And when your returns are improving, capital deployment.
Hmm.
That usually follows right behind.
And it did. They gave back over $30 billion to shareholders through dividends and buybacks. That's a 41% increase year over year. That kind of jump signals some serious confidence for management.
Absolutely. They're confident in the credit environment, and they're confident in their future ability to earn.
Okay, let's shift to the balance sheet itself. The growth figures were just as strong, and importantly, they kept stressing it was organic growth.
It was. Loans grew 8%, and they were pretty proud to point out that that significantly outpaced the industry average. That tells you they're winning clients and keeping them.
And on the other side of the ledger, deposits were up 3%. In this environment where, deposits have been flighty, just holding on is a win. Growing by 3% is great.
And it marks their 10th consecutive quarter of average deposit growth. It's a stable, reliable funding base.
So the total balance sheet is it's immense. It ended the quarter at $3.4 trillion in assets.
And critically, they are maintaining what is essentially a fortress-like liquidity position. They reported $975 billion in average global liquidity sources.
So nearly $1 trillion in ready liquidity.
Yeah. And this excess capacity, this is the strategic advantage they kept coming back to. It's capital they could deploy when they see high-quality opportunities, allowing them to be selective and grow smartly.
Okay, so that's the big picture. Let's dive into the individual business segments because that's where you see the color behind these numbers.
Right. And what's clear is that their diversified model is really performing. Let's start with the more cyclical businesses like global markets.
Which is their sales and trading arm.
Exactly. And they had a phenomenal record year. They pulled in nearly $21 billion in revenue from S&T activities. And what's really remarkable is this. It was their 15th consecutive quarter of improvement in that segment.
15 quarters. That's almost 4 years of sustained growth momentum. That's through high rates, low rates, volatility.
It suggests they've made some deep structural improvements to that business. It's not just riding the market.
It really does. And you see similar momentum in global banking, which is so crucial for the economy. Average deposits in that segment just soared. They were up $71 billion or 13% year over year.
Which reflects a lot of corporate confidence. But the real headline there was investment banking fees.
Oh, absolutely. IB fees hit their highest level since 2020, which management called the post-pandemic recovery peak.
Which immediately suggests that the corporate deal-making environment, M&A, IPOs, all that, it's finally starting to thaw out. It is. And management gave a really insightful explanation for why that's happening now. They pointed out that the fees they generated in the second half of 2025 were a massive 25% higher than in the first half.
Wow.
And they link that directly to corporate clients just having more certainty. Things like the big tax policy debates finally settling down, tariff rules becoming clearer.
The fog of uncertainty is lifting.
Exactly. The CFO, Borthwick, he had a great line. He said, "Certainty drives activity. When CEOs know the rules of the game, they stop hoarding cash and they start making moves again."
And then you have their wealth management business, which is just a true powerhouse.
Yeah.
Client balances grew by an eye-watering $500 billion.
To hit $4.8 trillion. It's just a staggering number. And the flows were strong. AUM flows, that's assets under management, were $82 billion, and total flows hit $96 billion.
When you add in the consumer flows, the firm attracted $115 billion in new wealth flows for the year. That's an incredible amount of new money.
It really speaks to the power of their integrated model. They convert banking clients to wealth clients and vice versa. It's a huge competitive advantage, a huge moat.
Okay, let's pivot to what is maybe the most important part of their future story: technology and digitalization.
Yes, this is the driver of their future efficiency. Management spent a lot of time on this, talking about how their multi-billion-dollar tech spend is actually hitting the bottom line now.
Right. We all know about Zelle for payments, but the real structural shift seems to be coming from their AI agent, Erica.
And Erica is not just some fancy chatbot for customers. They were clear that it's used across all their businesses and even by their own teammates. It's an internal efficiency tool as much as it is a customer service agent.
So the core message is that digital and AI are fundamental to their operating leverage strategy. It's how they plan to scale up their business volume without scaling up their costs at the same rate.
Precisely. And we'll get into some really revealing specifics on the AI metrics when we break down the Q&A.
Before we move to the forward guidance, what was their take on the broader economy? How are they feeling?
Moynihan's summary was pretty good, decent. They tracked consumer behavior so closely, and they saw consumer spending grow a healthy 5% to $4.5 trillion over the year.
And critically, people's bank accounts are stable.
Very stable. Account balances for the average U.S. consumer held up, and credit health actually improved. Delinquencies and charge-offs in consumer credit actually went down.
That strong consumer picture has to be the foundation for their whole outlook, right?
It is. It's why they remain, in their words, constructive on the future. They're projecting global GDP growth at 3.4% and U.S. GDP at 2.6% for 2026. They know there are risks out there, but they're clearly encouraged by the stability they see.
Okay, so let's dig a little deeper into asset quality because that's always where the risk for a bank lives. And the news here was surprisingly positive.
It really was. Their net charge-offs, or NCOs, that's the debt they've given up on collecting, actually declined for the second straight quarter.
And what was driving that decline?
Two key things. First, their credit card portfolio is stabilizing. And second, they saw lower losses in commercial real estate, which, has been a huge area of concern for the whole industry.
Right. So to put that in context, their NCO ratio, that's the charge-offs as a percentage of their total loans, fell to just 44 basis points.
Which is very low historically. It was
Mhm.
down 10 basis points from the year before. And their provision expense, which is the money they set aside for future bad loans, was $1.3 billion, which basically just matched the actual charge-offs.
So they're not seeing a big wave of trouble on the horizon.
No. Management said that given the good consumer trends and low unemployment, they expect NCOs to remain stable and historically low for the near term. It's a very favorable credit environment for them right now.
Okay, now for the star of the show this quarter, NII. We know it hit 15.9 billion, up 10%. What were the specific factors that drove that number so high?
Well, there were a few things that all lined up perfectly for them. First, you had just solid core performance from their loan and deposit growth, all managed with very disciplined pricing.
Okay.
But second, and this is the really crucial strategic point, they're benefiting hugely from asset repricing. They have higher yielding loans and securities that are actively replacing older, lower yielding assets as they mature.
And this is where the sheer size of their balance sheet becomes this massive, powerful tailwind for them.
It is. It's a huge ship turning in the right direction.
Hmm.
The final factor was a little technical detail. Client activity in their global markets division actually shifted about $100 million from fee income into NII for the quarter.
A temporary thing.
A temporary thing they hadn't perfectly forecasted. But even if you set that aside, the core NII performance was just outstanding. Their net interest yield, or NIY, improved by 7 basis points, reflecting that benefit of swapping old assets for new, higher-yielding ones.
And this all leads directly into their forward guidance for 2026, which was very strong.
Very strong. They reaffirmed their guidance of 5 to 7% NII growth for 2026, and that's based on the current market interest rate curve, which, already bakes in the expectation of 2 rate cuts this year.
So even with a couple of rate cuts, they see 5 to 7% growth. And that's because of this mechanism they kept stressing.
The fixed-rate asset repricing tailwind. This is as close to guaranteed money as you get in banking. They expect a massive chunk of their portfolio, between $12 and $15 billion of mortgage-backed securities and mortgage loans, to just roll off their books every single quarter.
12 to 15 billion every quarter. That's just an incredible annuity of earnings replacement.
Think about it. These are old assets that were locked in at like 2 or 3% years ago. When they mature, that cash is immediately put back to work in new loans or securities that are yielding 150 to 200 basis points higher.
Or they can just use it to pay down their own expensive debt.
Exactly. Either way, it's a huge benefit. And this continuous certain rotation of the balance sheet is the single biggest driver for their earnings over the next year or two.
That really makes that 5 to 7% NII growth guidance feel pretty concrete. What about the first quarter specifically?
For Q1, they expect NII to grow roughly 7% compared to Q1 of last year. And they were specific about the math. They said to use the Q4 number minus that temporary $100 million shift as the base. So a very strong start to the year is expected.
And finally, on expenses. We know operating leverage is the whole strategy.
It is. They're targeting about 200 basis points of operating leverage for the full year 2026, but they did give a very specific warning about Q1 expenses.
Right, they're expected to be up about 4% year over year. Why that temporary jump?
It's mostly seasonal stuff. First, you have higher compensation costs that go along with strong sales and trading activity. Second, payroll taxes are always heaviest in the first quarter.
Okay.
And third, they got a one-time net benefit in Q4 related to that FDIC special assessment fee, and that's not going to repeat. But even with that 4% bump in Q1, they still expect to generate operating leverage for the quarter, which just proves how deep their cost discipline is running.
That's a really comprehensive look at the prepared script. I mean, the picture they painted is one of structural strength, these guaranteed tailwinds, and just an intense focus on efficiency. Now, let's get to the Q&A.
This is where the analysts get to push back and we get to see the nuances.
Exactly. This is where we move from their curated narrative to the high-stakes cross-examination by Wall Street. We're going to break down the questions and the strategic replies, starting with a question that immediately challenged their efficiency target.
Yeah, this first one really set the tone for how management was going to handle the optics of their performance.
So first up was Betsy Graysick from Morgan Stanley. And she jumped on a recent accounting change that basically boosted their reported revenue figures without actually changing their net income.
Right. It just moved things around on the income statement. So her question was pretty sharp. She focused on the downstream impact. Since revenue looks bigger, your efficiency ratio, which is expenses divided by revenue, automatically looks lower.
So she asked, are you going to lower your official medium-term target range? It's currently 55 to 59%.
Yeah. She even suggested a new range of 54 to 58%. And Alistair Borthwick's response was very careful. He refused to adjust the guidance at this stage.
So he didn't take the bait.
He did not. He was careful to say that the existing range is, quote, not a cap on ambition. He said they're going to keep driving towards that target with real operational improvements, not accounting tricks. And once they get there, they'll reassess. The message was clear. Focus on our execution, not the mechanics.
Okay, next up was Ken Usden from Autonomous Research. He followed up on the expense path, pointing to that 4% growth they guided for in Q1.
Right. He wanted to know what's driving the absolute expense growth, and more importantly, what has to happen for them to hit the upper end of their operating leverage range, which is more like 200 to 300 basis points.
And what did Borthwick say?
He explained that a lot of their costs are what he called revenue aligned. So in areas like wealth management, markets, investment banking, if revenues go up, costs will naturally follow because you're paying for talent. But the profitability is still very high.
But that's when Moynihan jumped in with really the strategic centerpiece of the whole call.
He did. Moynihan laid out their #1 long-term strategy for expanding leverage. And it's all about using technology, especially AI, to strategically reduce headcount over time.
And he gave this crucial fact. Bank of America has a high natural turnover rate, something like 7 to 7.5%.
Exactly. So his point was they don't need big layoffs. They have 14,000 people leaving every year just naturally. Their strategy is to deliberately make decisions not to hire replacements for many of those roles and let technology and efficiency absorb the workload.
So headcount will just drift down, as he put it.
That was his phrase. It's this controlled friction against their natural labor churn that is their single biggest lever for cutting costs structurally and hitting that upper end of their leverage target.
Which leads perfectly into the next question from Mike Mayo at Wells Fargo, who is famous for drilling down on tech.
Oh, yeah. He came in hard. He wanted specifics on tech spending, AI outcomes, and he flagged this really critical detail on their slide deck.
The Erica metric.
The Erica metric. He asked why customer interactions with Erica actually decreased while the number of users increased. On the surface, that looks like a failure.
But the answer was, I think, maybe the most compelling insight of the whole call.
I agree. Borthwick first gave us spending numbers, over $13 billion total on tech, with over $4 billion of that on new initiative, which is up 5 to 7%.
So they are investing heavily.
Heavily. And he gave the tangible ROI. He said AI has already taken 30% out of their software coding process, which saved the equivalent of about 2,000 people's work this year.
But back to that Erica dip. Why did interactions fall if it's so successful?
This was the brilliant part. Borthwick explained that the decrease is actually a sign of success. Instead of waiting for a customer to log in and ask Erica a question, the system is now sending out billions of proactive digital alerts.
So they're solving the problem before the customer even knows they have a problem.
Precisely. They're telling you about a low balance or a potential fraud issue before you even have to ask. It improves the customer experience at a dramatically lower cost. Their goal is shifting from handling the interaction to preventing the interaction.
Fascinating. Okay, next we had John McDonald from Truist Securities. He focused on their future return profile.
Right. He was trying to connect the dots between their capital management and that ambitious 16 to 18% ROTCE target. He wanted a timeline. How are you going to get from here to there?
And part of that is reducing their CET1 ratio, their capital buffer, which is at 11.4% right now.
Yeah, and Borthwick confirmed the plan is to let that CET1 ratio drift down over time through dividends and buybacks. But he was also cautious
Because of the regulators.
because of the regulators. He said they need the final regulatory rules to be settled before they can get more aggressive with buybacks. They don't want to get out ahead of the rules.
Okay, so what about the timeline for that 16 to 18% ROTCE target? That's a huge jump from where they are now.
It is, and they set a very specific, and I would say patient, timeline. They expect to get into the lower part of that range, so 16%, by the 8th to 12th quarter, so sometime in 2028.
And that's all contingent on two things.
So things, sustained organic growth and that massive fixed-rate asset repricing tailwind hitting the bottom line without being eaten up by rising costs. Their confidence rests almost entirely on that guaranteed NII benefit.
So it's a delicate balance. They need execution, capital deployment, and cost control to all work in concert.
Absolutely. The NII repricing is the certainty, but the risk is in the speed of everything else.
Okay, next question was from Matt O'Connor at Deutsche Bank, and he was focused on the lending side.
Yeah, he wanted to know how sustainable that market-beating 8% loan growth is. And he asked for an update on their efforts to grow their credit card balances.
Right, because card spending was up a healthy 6%, but the actual balances people were carrying weren't growing as fast.
Exactly. On overall loan growth, Borthwick was very confident. He said their whole NII forecast already assumes mid-single-digit loan growth for 2026. They see commercial leading the way, but consumer picking up.
But the credit card piece is where they really need to accelerate because that's a high-margin business for them.
It is. And they confirmed they're very much focused on accelerating it. They pointed to some big strategic investments they're making, like World Cup sponsorships, new co-brand partners, and enhanced rewards programs to drive more usage and, crucially, more revolving balances.
So Erica Najarian from UBS circled back to the efficiency ratio communication. She was basically suggesting that the way they were talking about it might be confusing the market and hurting the stock.
Yeah, she challenged Moynihan directly. She said, why not just adjust the target down and be done with it, acknowledge the accounting change?
And Moynihan got pretty firm here.
He did. He basically said that debating the nominal numbers is a distraction. His core message was to focus on delivery. Are we growing revenue faster than expenses? Yes. He said on an apples-to-apples basis, they've already improved the real efficiency ratio by a couple hundred basis points.
So he wants the market to focus on the operational excellence, not the optics.
That's it, exactly. His whole goal is to make sure every dollar of that extra NII from the repricing tailwind drops to the bottom line. And the only way to do that is with ironclad expense discipline, driven by that AI-enabled headcount reduction.
Okay, next up was James Mitchell from Seaport Global Securities. He wanted to get into the weeds on deposit pricing.
Right. He asked about deposit betas. So how quickly will they pass on rate cuts to their depositors? And he also asked about the outlook for NII, specifically from their global markets business.
And the answer on deposit pricing was really a tale of two customers.
It was. Borthwick explained that for their big corporate and global banking clients, they pass on rate cuts immediately. High beta. But for the consumer business, it's far less sensitive because they have this huge base of non-interest-bearing checking accounts.
Which is a massive funding cost advantage.
A huge advantage. And he noted a positive sign. Consumer checking account balances are now actually starting to grow again, up 2% year over year.
What about the market's NII?
He said they expect it to grow in 2026. They're investing more in that balance sheet, and that business is liability sensitive, which means rate cuts actually tend to help the NII generated there.
All right, Christopher McGrady from KBW asked about two really critical topics,
Yeah.
funding and a big regulatory risk.
He did. First, he asked how much more room they have to optimize their funding by getting rid of expensive wholesale debt. And Borthwick said they still have about $50 to $100 billion of that stuff left to get rid of.
That's a lot of potential cost savings still on the table.
It is. It just further reinforces their path to higher profits. And on the lending side, he confirmed they're pushing for growth everywhere because they have the excess capital and deposits to do it.
Okay, now the big one, the regulatory risk. The proposed 10% cap on credit card yields.
Moynihan took this one personally. He was very clear. While BAC has its own affordability products, he warned that a federal cap would have significant unintended consequences.
Meaning it would hurt the very people it's intended to help.
Exactly. His concern is that it would force the entire industry to pull back on risk, which means they would stop lending to lower income or less creditworthy customers. It would essentially cut off credit for millions of people.
Glenn Shore from Evercore followed up on deposits, asking why consumer deposit growth was still a bit sluggish, even with a strong economy.
Yeah, and Moynihan had a very specific answer. He said it was primarily driven by their wealthy clients, people in the wealth management business, moving cash into high-yielding alternatives like money market funds.
So it's the high net worth customers chasing yield, not the average consumer pulling their money out.
Precisely. And he said the behavior has now stabilized. The worst of that deposit migration seems to be over, which supports their forecast for consumer deposit growth to accelerate in 2026.
And on the investment banking pipeline.
Borthwick said it looks good. He said that certainty in the regulatory environment is allowing clients to finally pull the trigger on deals, and he emphasized their strategic investment in expanding their physical presence into more cities to capture more of that middle market IB share.
Okay, we had Stephen Schuback from Wolf Research, who focused on global wealth management, or GWM. He questioned their confidence in hitting some pretty aggressive targets there.
Right, a 30% margin and accelerating organic growth. He was basically asking if the cost of recruiting advisors would get in the way.
But Borthwick was very confident.
Very confident. He pointed to their competitive advantages, the combination of banking and wealth, digital and local. And he made a key point. Their strategy is less about expensive external recruiting and more about training their own advisors internally, which makes the investment more manageable.
And he also asked about the long-term tax rate.
Yeah, they confirmed 20% for 2026. But looking further out, he said a very modest upward drift is possible as some old tax advantage deals and tax credits start to expire after 2027.
Gerard Cassidy of RBC brought up one of the most high-stakes systemic risks of the whole call.
He did. Stablecoins legislation. He asked about the industry-wide risk of deposits flowing out of the banking system.
And Moynihan's answer was pretty stark.
It was. He acknowledged the industry's huge concern here. Studies suggest up to $6 trillion in deposits could flow off bank balance sheets and into stablecoins.
6 trillion. And the implication of that is
A massive reduction in the banking system's ability to lend, especially to small and medium-sized businesses. Banks would have to find more expensive funding, and the cost of borrowing would go up for everyone. It was a clear message to regulators to be careful.
And what about the risks they're focused on internally?
He said they're constantly running severe stress tests, like a 50% drop in house prices, 10% plus unemployment. He feels the industry is in very good shape with low stored risk right now.
Okay, last question. Saul Martinez from HSBC.
Right. He asked for clarification on what a normal loss level would be and about deposit growth acceleration.
And on losses, they stuck to their guns.
They did. Borthwick reaffirmed their through-the-cycle expectation is for an NCO ratio of 50 to 55 basis points. They're running well below that now at 44, but they're being realistic about the future.
And for consumer deposit growth in 2026.
He confirmed they expect it to be slightly higher than the 3% they got in 2025. He said historically it runs around 4 to 5%, and with checking account balances already turning positive, they see that acceleration coming.
Wow, that was a rigorous session, but it feels like management successfully defended their strategy on pretty much every front.
They really did.
Okay, so let's pull this all together. Let's synthesize the most vital knowledge you need to take away from this. We've gone through the numbers, we've gone through the cross-examination. What were the biggest, most impactful themes?
Well, I think the single overarching theme is that Bank of America feels it's structurally positioned for a really significant earnings boost over the next 3 years. And it's driven by two very powerful interconnected forces. Those guaranteed NII tailwinds and these aggressive tech-driven efficiency gains.
Yeah, their story feels like it's shifted from speculation to just execution.
It's all about execution now.
I have to say, the most compelling part of this for me, thinking about the long-term health of the company, is this structural shift being driven by AI and digital. I mean, Erica, Copilot. These aren't just buzzwords anymore. They are tangible, measurable drivers of their operating leverage.
Exactly. We got concrete numbers. AI saved the equivalent of 2,000 headcount in their software development process alone this year. That allows them to bring in 2,000 new college grads, let natural attrition run its course, and still see a steady structural decline in their overall headcount.
Which lets them hold core expenses flat, even with inflation.
Right. That operational excellence is the foundation for everything else Moynihan wants to do.
And that aha moment for me was the reason Erica interactions went down. It just defies intuition. But it means they're succeeding at a higher level.
It does. The proactive alerts are solving problems before the customer even have to ask. That is the definition of superior low-cost service. It turns a potential expense into a digital efficiency gain.
Okay, theme number 2, their ambition on ROTCE and those NII tailwinds.
Yeah, their path to that 16 to 18% ROTCE target it's very dual-engined, and they're being patient about it.
So on the earnings side, the numerator, that NII benefit, is basically a certainty that's just built into their balance sheet.
It is. It's almost guaranteed. That tailwind is driven by that $12 to $15 billion of old, low-yield assets rolling off every single quarter and being replaced at yields 150 to 200 basis points higher.
And Moynihan's mandate is simple. Don't let the expense base grow, so all of that extra NII drops straight to the bottom line.
Dollar for dollar. And then you get the mechanical boost to ROTCE from the capital side, the denominator.
Right. Their plan to gradually reduce that conservative 11.4% CET1 ratio through buybacks once the regulators give the final word.
That will mechanically boost ROTCE significantly, even before the full earnings benefit from the NII hits. It's a very calculated, patient 1-2 punch.
Okay, third big theme. Credit stability and their plans for future growth. I was genuinely impressed by how robust the credit picture is.
The NCO ratio at 44 basis points is just historically low. It really contrasts with all the economic anxiety you see in the headlines. And management is constructive. Their own long-term expectation is only 50 to 55 basis points, so even if losses normalize, it's totally manageable.
And they're not just, hiding and playing defense. They are actively pushing for growth everywhere.
Everywhere. They have the excess capital and deposits to back it up, so they are aggressively looking for high-quality loans across all segments. Commercial is leading, but you see the consumer side starting to turn. They're funding everything from middle market expansion to, yachts and art collections for their wealthiest clients. They are confident.
And finally, we saw them really engage with those big regulatory risks.
We did. And their commentary on the card yield cap and stablecoins was less about their own business and more of a systemic warning to Washington.
On the card cap, Moynihan basically said it will create unintended consequences.
Yeah, he's worried it will force the industry to stop lending to the very people the rule is trying to help. And the stablecoin threat is genuinely systemic.
It's not just another crypto debate.
No. It's a systemic threat to lending capacity. The potential for $6 trillion in deposits to leave the banking system is real. And if that happens, the cheap funding for small business loans disappears and the cost of borrowing goes up for the entire economy. It's a small business funding issue, not just a banking issue.
So to wrap up all the knowledge from today, Bank of America is executing a highly disciplined, tech-forward strategy. They are perfectly positioned to capture these huge, almost guaranteed NII tailwinds, all while maintaining historically strong credit and pushing for growth.
The structural story here is just so fascinating. Moynihan said their expense targets are so aggressive that they expect their overall headcount to actually drift down. So, considering their strong revenue growth, if AI can truly offset the need to replace thousands of employees every year, the provocative question I'd leave you with is this. How much lower could their structural expense base actually go in the next 3 years?
Could they actually get their efficiency ratio below 50%?
Could they? If the AI productivity gains are as real as they claim, it might be possible. That's the ultimate test of their strategy.
And it speaks directly to just how achievable that 16 to 18% ROTCE target really is. Thank you so much for diving deep into the Bank of America earnings call with us today.
It was a pleasure.
If you enjoyed this detailed breakdown and you found value in what we do, please make sure you click that like button, share this with your friends and colleagues, and subscribe so you stay tuned for all of our upcoming content.
And if you haven't already, please do take a moment to evaluate the membership options. Your support is absolutely essential, and it helps us maintain the quality and the depth that you see in these videos.
You can also show your support directly with a super thanks. We really do appreciate you joining us, and we look forward to seeing you at the next one.